Absolutely, I would say indicator for the success of the economy is the financial services industry, and banks definitely play the most critical role.
For banking sector, I always look to three points: scale, speed, and providing secure services. If you are able to address the three S, you will give a big push to the economy and should be growing much faster.
You would have seen that LCR. See, we have a scenario where we are moving towards digital in a much faster pace.
Right.
When the digital adoption is going to have a higher outflow, is going to be detrimental to that particular conceptual or policy measure. So naturally, that LCR measure has just brought us down, and it provided a level playing ground.
To keep the banking sector safe and fit for growth for this period, because that reflects India in the external economy of the world.
And the way I look at it is the regulator has both the accelerator and the brake in his hand, right? And the trick is to play both at the right level, right? Too much of brake or too much of accelerator, both are not great. But the right balance between the two is right.
Hello and welcome back to Fortune India's yet another exciting boardroom series, and this time the topic is on banking, the biggest proxy to play the India growth story. And co-moderating the session today with me is my colleague Ashutosh Kumar, and we have an eclectic panel of guests who represent not just the central bank. We have someone from the professional services, the auditing industry, and we have got some top-notch bankers with us today. So the topic this time around is pursuing growth and managing risk. It's like there's nothing new about it. That's what banking has always been. Mr. Marathe, to contextualize, today the most aggressive banker on the street is the Reserve Bank of India, given what it has done in terms of cutting the repo rate and also easing liquidity with an aggressive CRR cut. Could you give us a sense of why the RBI has done what it has done, considering the fact that growth has in some sense been there, but what is it that the Reserve Bank is more focused on?
See, Reserve Bank is equally focused on inflation management and also on growth. For a very long time, we were not getting the results on the inflation front that we wanted. And the food segment of it, which accounts for almost 40+% in the overall calculations, they were not being tamed for a variety of reasons, we know. And consistent efforts by the government and strong liquidity management by the Reserve Bank ultimately has given, because the government has taken several steps on the supply side, whether it is the edible oil, whether it is something like coal, something like planning adequately and diversifying on import of crude, and then a variety of other things also. So ultimately we have been able to tame the inflation, and we see that unlike in past several years, even in the summer period, the inflation has been low. So we were only waiting for an appropriate time to reduce the rates. So that's the reason. It's not that it has happened suddenly. It was well timed, it was anticipated, and it has happened. And liquidity, see, there have been a variety of reasons. The credit growth has been substantial in the last few years, and the growth of deposits has not kept pace with it. That is also one of the reasons for liquidity. And to some extent, particularly some of the larger banks, the central government's decision to release funds just in time to the ministries has also impacted the CASA and consequently the deposit base. So to ease liquidity, the Reserve Bank has been taking proactive steps, and that's what we are now getting at. There is enough liquidity in the system, and so that all segments which are in need of credit should be serviced properly.
Sir, one point over here, in fact,
apart from the reduction in the rate and the CRR cut, a lot of measures have been, in fact, a barrage of measures have been taken by the RBI. In fact, I'd like to ask the entire panel to have this view on how these specific measures, be it related to easing gold and project finance guidelines, and your relaxation on the LTV front, or the liquidity coverage ratio guidelines, how will these boost credit growth in the economy, so to say, sir, for the banks? Starting from you, sir.
See, the slew of steps and measures taken all are directed in only one direction, which indicates that we have to spiral the growth. So we talk about the growth, it doesn't mean that the growth was not happening earlier.
Right.
Growth was there. Possibly we have to accelerate the growth, and it has to be little deeper and wider with an all-inclusive growth. So you look at it, your risk weight for the microfinance was just jacked up by 50 bips earlier. It was brought back, clearly indicating that that's a segment where they want more and more people to be inducted into the formal banking. Right. So you look at it, that is the first entry point for anybody who wanted to become in the formal banking sector. They have been in the private borrowing space. The second important thing is you would have seen that LCR. See, we have a scenario where we are moving towards digital in a much faster pace.
Right.
When the digital adoption is going to have a higher outflow, is going to be detrimental to that particular conceptual or policy measure. So naturally that LCR measure has just brought us down, and it provided a level playing ground. And another one is you have an NBFC, you have a banking sector. You can't have two different measures which is going to be take away the level playing ground for the people. For example, if I fund to NBFC, the risk weight cannot be higher. Yeah. They in turn give it to somebody, the third party in MFI, it can't be lower. So that the level playing ground has been brought in. The another very important thing which in my view is going which will definitely trigger the next wave provided the investment takes place from private sector is that the project finance. Right. The country needs, when we are looking at 2047 as a developed nation, you have to necessarily kick off the growth maybe in around 7-8 ranges. If you are thinking of 7 or 8% as a range, banks cannot grow at 30-40%. It has to grow at 1.3 to 1.5% over that is a normal growth, which will manage the risk. Right. So if you look at it consistently from now till 2047, if you want to clock around 7.5, actually these measures are the trigger or the kickers.
Right. So how does it play out in in your segment, basically the small banks?
Sure. Actually, it's a very interesting time for India. It's a once in a lifetime for banking under our watch. It's not every decade that a country goes from the 5th largest GDP to the 4th largest GDP, and I'm quite sure certainly in the next 4 years to the 3rd largest. The Reserve Bank is charged to keep the banking sector safe and fit for growth for this period, because that reflects India in the external economy of the world. As such, the Reserve Bank is ensuring that it's a robust banking system with checks and controls not only in InfoSec and IT, but also on prudential ratios which we keep with us. Whether you're a small finance bank or a large private bank or a big public sector lender, our role is actually uniform. We constitute the banking industry of India, and we are as strong as our weakest link. Reserve Bank has taken this very, very close to their heart, and I've seen a slew of very benevolent changes which the Reserve Bank has put together in the last few years. I had a discussion with the Governor, Mr. Sanjay Malhotra, last month, and the vision he has got is absolutely stunning. It's on how each one of us contributes to making our segment and our domain, our cohort, the best in class of what we serve. Because collectively, it's not just urban India or the Fortune 500 companies. Tier 4, Tier 5, the MFI woman on the last leg, the marginal farmer, everyone has to be served for us to grow as a country. So by giving benevolent changes, for example, the very last one was PSL being reduced for SFBs from 75% to 60% has opened up classes for us to go and lend secured assets, lower risk assets, and basically fueling growth for us. So I think it's a very positive sign that the banking industry and the regulator are working together for the growth of this country and to keep it a very shining example as a country across the world.
Right. So,
Keshav started this conversation saying that banking is almost proxy to the economy for a good reason, right? So my sense is that if you really want to push economy and growth, it's important to have a healthy banking sector which is also growing and is able to fund the growth, right? And the way I look at it is the regulator has both the accelerator and the brake in his hand, right? And the trick is to play both at the right level, right? Too much of brake or too much of accelerator, both are not great, but the right balance between the two is right, is the way to go. And these measures that you talked about are an indication that RBI is very clear that they need, of course, they need to keep the sector in good health, good shape. They need to worry about the depositors and the risks around the sector, but at the same time they have to push for growth of the economy, and therefore which will lead to the growth of the sector. And I think all these measures are a recognition of that balance.
Right. So Manian, just on that analogy of, accelerator and brake, if I just refer to the recent policy measure that the RBI has given the accelerator full press, but the policy stance is like an emergency brake. It says certain neutral. So what do you make of it? Because the central bank is also in some way gives a sense of, what the banks, the industry in general should think about it. So what is the takeaway? What is the signaling that you take away from this recent policy?
So my sense of my takeaway was quite consistent in the sense they said we have gone one full hog once for all, because we don't want to keep the uncertainty on, and therefore we are also making it neutral. So the market should expect, at least the market expects, the next 12 to 18 months there is not too much rate change, and hopefully he is also, without saying so, he is probably now, I think monetary measures are done, and therefore now government policy and fiscal measures have to come in to push growth. So I think the monetary side we have played our hand. If you ask me, that's the reading I had, and hand transparently saying that here is it. We have done it for the next 12 to 18 months, and now it's others to pitch in for growth.
Ms. Parthasarathy, what do you think of it? Has the central bank laid out all the cards on the table, or does he hold some few aces?
and how does the banking sector now per se take the mantle, take the torch ahead, so to say?
Just to clarify, what I said does not mean the governor doesn't hold any more cards. Governor always holds
Cards. Absolutely. See, we are talking about the central bank and the policies that you mentioned, Ashutosh, right? All are done in definitely keeping 2-3 dimensions in mind, right? Number one, the country has to grow. We are not looking at all in terms of moving from the 2047 goal for the country.
Right.
That's pretty clear. And what is the leading, absolutely, I would say, indicator for the success of the economy is the financial services industry. And banks definitely play the most critical role. So if you have to make sure that your leading indicator for the economy to be successful, then enable the banks with all the ammunition that they need. Whether you want to help the financial inclusion, MFI, PSL, whatever the part of it, or the absolutely in terms of the credit growth has been good, but how you can further increase in unstabilize the credit growth, and at the same time be very cognizant of what needs to be done for the depositors, and also increase the kind of right in terms of products that the bankers can be able to come up for the depositors to trust and put their money into it, right? With the country also in the process, we have to remember that from a savings country, it is slowly moving into an investment country because the wealth products are picking up, etc. So you have to also enable the bankers to make sure the deposits also have an equal balance, right? When you're doing all this, not that I would say that I'm nobody to say that all the cards are right, used kind of a thing. What they have done till now is phenomenally good for the sector and for the sector to boost the growth and which will boost the country's growth. That's absolutely clear and abundant. That's the primary message from that, right? And of course, will there be things that will be done further? The answer is right, known into multiple stakeholders of the country who will definitely manage this growth, which cannot be compromised, right? That is a clear message. That's what I see in terms of doing it.
Mr. Marathe, in recent years, it seems that more than monetary management, the RBI is seeing itself as in a role of, pushing growth. I mean, even if the recent commentary that has come post the big bonanza is that the RBI is clearly not comfortable with the growth that the country has by. So are we seeing a different kind of an approach in the way central bank sees itself, its primary role now?
See, the whole approach in the country today is don't look to the past and compare your growth. Set new standards because we have a long way to go. That is number one. And one of the thinking amongst when we discuss is high time for all of us, all stakeholders in the financial sector is, and particularly banks of different segments, need to relook at our business models. If we have to grow fast, we need to have a relook at the business models for supporting the growth. See, even today, on a conservative basis, if I have to say, there could be about 50 crore people who do not have a bank account, despite Jan Dhan accounts being opened in such a large number. Similarly, we have 7.5 lakh villages in the country with 700 districts. And has the financial sector reached out? There are huge untapped financial resources in the rural sector and semi-urban sectors, and I would say even in large cities like Mumbai. So banks have to rework, not only public sector or private sector, the entire industry has to rework their business model, reach out to more, and there is huge scope still for their growth. That's how I look at it. One point that I have always been thinking is the banks have not been doing justice to the depositors. That's what I've always felt. They are paying good dividends to the investors. Borrowers are being enticed with low interest rates and a slew of concessions. And then provisions are healthy, banks are good, that's all good. But at whose cost? It's at the low deposit rates that is eventually going to be a big challenge for us. And CASA is going to be a still bigger challenge. That's the reason why I said you all need to relook at the business models that we are going to pursue. One more point I would like to mention is it's not exactly the hard figures, but the income levels in our country of the banks, it can be split into two things directly, interest income and non-interest income. The non-interest incomes is very low. It's hovering between 10 to 12% depending upon each bank. Whereas abroad, it's about 30%. So we need to expand services that the banking system can offer, earn non-interest income also, and do justice to depositors also. That's the way forward I think we'll have to go.
Right. Mr. Manian, just taking off from what Mr. Marathe said, reimagining business models. Now, that's the whole fundamental premise that how differently disruptive can a bank be in a regulated industry? Yeah.
There is always wiggle room to be innovative, whatever the regulatory constraints. Of course, yes, it's a regulated industry, safety is important, and therefore you can't allow unhindered innovation and drive the system to risk. So one understands that, but I think within that, Indian banks have been fairly innovative. It's not that they haven't been innovative over these years. So I think giving more freedom for innovation from where we are is of course possible. But more importantly, taking off from where Mr. Marathe left, I think going forward, he's right that business models need to be, reimagined. One of the areas for banks in India is, I think the cost to serve and cost to income that ratios that banks have in India, or cost to assets ratios that banks have, I think has to go down. 2 decades of intense technology has still not brought down that significantly, right? Most banks operate between whatever 45 to 55 percent cost to income ratios. I think it's still very high. To be able to give either more to depositors or charge less to customers, I think that has to compress. And personally, I see a big opportunity whether going forward AI can help us do that. I think there is a potential where not just technology but AI and technology can drive costs down, because finally we have to optimize that cost. If we have to serve better, what Mr. Marathe said, I mean, we have to create that room for either paying depositors more or charging
So
customers
that's an
less.
interesting point that Mr. Manian you made on, that, despite spending so much on technology, banks have not been able to. So Miss Ma'am, if you could give an interesting take, because if I look at
it's a
the
interesting point and a very valid point, right? And I fully concur with Mr. Manian on that. A lot of money every bank actually has been spending in the last 2 decades, especially on variety of programs, transformation, digital, right, in terms of core data, regulatory expenses, which is like, in terms of, I'm not even looking at the discretionary spend on consulting and technology, right, that will go, but absolutely based on the regulations that are required to spend the kind of money that the banks have been spending, it's immense. But for that investment per bank, which is an X percentage of the cost income ratio, have we got the ROI of the tech investment? The answer is a big no. Answer is definitely a no. So we need to consolidate the investments going forward to see that there will be a singular ROI from the technology investments that will come for the banks, which will then release that to spend in either growth or in depositor return or whatever that the banks want to. It's up to the bank at the end of the day in terms of where they want to do. That's one angle, right? In terms of the technology. Also in technology, customer expectations have gone from, I would say, from bottommost to where, right, sky high. Sky is also maybe is not the limit. Maybe we have to go to the space somewhere, right, in some other world. The expectation of the customers have become so high, and to meet the customer expectations, right, and the technology, somewhere the balance have to be drawn on how to get the customer expectations in line with, right, what can be given to them and how the ease of operations can be given to them. So it's one, getting the operations excellence even in delivering the customer experience, right? Those things can be achieved through AI, Gen AI, agentic, you name it, right? You have variety of tools nowadays to do a proof of concept and then deliver. But these are very important because the spend is very high in meeting that customer expectation also. I will leave that factor also to think, right? Because it's a big number that every bank is spending.
Can we intervene for a minute?
yeah,
To just supplement what she said. Not all banks who have provided for technological upgradations have been able to spend the money.
Yeah.
And many have not been able to fulfill the targets which they set for themselves. And that is one cause of concern also.
Okay.
Adoption of technology comes later within the organization. But creating the necessary infrastructure to first install and then imbibe it is also what is required to be done. And then there is something which is required to be done by each bank at the bank level to re-engineer their operations completely in the change context. That has been a very slow process because any change is always gets resisted. So we will have to overcome the resistance, yet move ahead with re-engineering of the operations to bring down the cost, optimize it basically.
Mr. Kumar, what's your take on what Mr. Marathe just said?
Yeah. We have been talking about what differentiation, customer expectation, customer experience in different tone and tenor. So the banking remains same, accept deposit and give loan, right? What has changed is that the way it is required to be delivered. You can't change the way I'm accepting a deposit. Maybe that X bank will have some couple of products which is slightly different, and the market is so fast. Adaption of the changes and innovation, the period was used to be 1 year between the competitors. Now it is dropped down to 3 months. Nothing is proprietary today, right? So in the fast changing world, what has really, imagine a couple of decades before, we have moved away from compulsive banking. If I have to take a checkbook, I have to walk up to the branch bank, sign up the things and give it. From compulsive banking to also banking. Also banking is like going to a petrol bunk is a compulsion. Petrol will not come to my home. But when I go to the petrol bank, I do a couple of things. I get my car washed, I get my ATM money withdrawn, I get my grocery purchased, things like that. So that's also banking. Now we have moved away from the compulsive banking to in these circumstances, nothing but natural, the expectation of that end user will be the experience of what he gets on a similarly placed platform. Why everybody takes that, get me the e-commerce platform facilitation in this banking also, why can't you give the services similar to what it is? Expectation is no doubt, it is bound to be there, it is bound to improve also. The reason being that they are able to ask a very simple question. When I could order my grocery to be delivered at home, why I should not order a cash to be delivered at home? Nothing wrong in it. So possibly when there is a conflict of the cost of delivery and the cost of doing the service comes into picture, right? The grocery you are going to buy every month. Milk you are going to buy every day. I get subsidized the services because of the repetitive in nature. You are not going to withdraw cash every day. Right? You are not going to ask for the checkbook every day. So naturally the cost of delivering 1 unit and 1 unit of the service with a sporadic gap is going to be higher. So possibly we have to develop a culture of ready to pay for the services will definitely bridge this gap what we are seeing it today. That mindset has to come because today we are always in the mode of killing. I will advertise saying that I'm giving 10 services free, 20 services free. All those services will be something which I rarely use it. Right? The really using services, we have to educate and accept the fact service demand is a must and service delivery is a must. But the service quality, if it is meeting your expectation, you should be able to pay for that quality. Taking a coffee in Taj and taking a coffee in my Nair shop is totally different. Both are coffee, right? Both are tea. But I definitely pay for the services. So that is exactly the change. I'm not telling you that it's not happening. I'm just seeing it in the affluent banking segment. If you look at it, people are ready to do the service. We have banks who are ready to receive your concierge services. The moment you land, the people are ready to pick you up and then land you back at your home and then help you out every other services. So the banking no longer stopped with your primary deposit advances. Deposit advances is the primary hook. Nobody else can do, bankers have to do. And associated services is developing now today. If you look at wealth management, somebody was talking about the wealth management. So I have some fund. Should I hand it over to you for deploying it gainfully because I don't want to use my money to be spent with 10 different people. So that kind of affluence is coming up in India. If you look at it, the rate of people upgrading themselves to that of the low income to the mid income to the mass affluent to the affluent is phenomenally great. How it is happening? You must give credit to that government actions and initiatives. Somebody was telling about the zero-day disbursement, right? No, government is able to offer the services at reduced cost. So the banks have to reimagine to say that how I can offer my cost of delivery of the services similar to the government by cutting other wasteful expenses. Take technology. The core technology has been adapted to every bank. No second opinion. Like 5 years before the RBI did an inspection, the core itself was an issue. Now the core has been fixed in every bank. Above the core, we are building some platforms and digital. That digital platform which we are building it up, till you reach a scale, the cost can never be recovered. And to achieve that particular scale, you have to do a lot of innovations. Innovation of delivery, innovation of the product. Now the product is same. My deposit is going to earn me either a monthly interest or a daily interest or a quarterly interest. There's not much of a change. But how do I make it easily? It's a single click is going to help him to do it. Normally, we have a very easy journey for acquiring a customer. But we do not have that easy journey for a customer to quit himself. It is his option. So it is happening, but it is not happening at the pace at which is required to be done. Possibly the days are not far off because everybody is talking. Today we are talking about that kind of change here. So naturally adoption is not far away is what I feel. And I can tell you with my own experience, because I am associated with the financial inclusion since first Bhamasha project of the country where it has happened in Rajasthan, very closely associated. The day on which when we went for opening an account of women in Rajasthan, I'm talking about 15 years before, and today, you don't have to worry. You tell them that you have to pay me the money. I said, GPay karna hai kya? Look, if people ask me a simple question, say, look at the penetration of technology, which the people thought it is very difficult to do in our country, has penetrated so deeply. So the adoption will be faster. But what the gap today is the financial literacy. If we are able to bridge the gap of literacy and the financial literacy, possibly this adoption will be much faster and accelerated.
Sir, one point is there over here. You've talked about the experiential thing and the aspirational thing also, but there is also a structural change happening in the banking. There is a lot of movement from the traditional FDs to the mutual funds. I would like to pose this question to basically the bankers on the panel as to how you guys read into it actually, and what's really happening. What could be the, what could be the way forward? What could be the consequences?
See, I'll just look at it this way. The entire population put in 5 different segments or 3 different segments, which is the segment. As you move up the pyramid, your opportunity to improve to the multiple assets increase.
Right.
The moment you move up and provide them an opportunity to the multiple assets investment, you have to provide the service as a banker on a fee. You was making a point of it. So the fee-based service is going to help you to compensate for that, may not be fully, but it is going to step up. Second, your ability to again reach out to the bottom of the pyramid. So today our savings rate is maybe 30% or whatever it is. Still he was talking about 700 districts and 7 lakh villages.
Right.
The people of nobody is talking about micro deposits. I as a banker is comfortable in lending to an NBFC who will go to the last mile, but he doesn't have an ability to mobilize deposit. So naturally we have to redefine and say that how will I able to mobilize a deposit? Maybe it's a micro deposit which has to get, and the days are not far off. I'm seeing it. Jan Dhan is a classic example, whether you may debate it's good, bad, ugly, or whether achieved or not. I've seen before Jan Dhan, today Jan Dhan. The Jan Dhan accounts migrating from the Jan Dhan to the regular account is a phenomenal rate, which clearly indicates the people down the pyramid are moving up.
Right.
So up the pyramid, they may be having an alternative asset class, but down the pyramid, you have a big opportunity. So another decade, I don't think that will be a challenge, provided we are able to retune and fine-tune our radio.
Sir, FD versus mutual funds, how do you negotiate this challenge? A structural shift, so to say.
I think that's not even a relevant question. The question is how to get more liabilities into the regulated economy. To my mind, FDs and mutual funds are 2 sides of the same coin. It's the investment option of the person, whether he prefers risk-free deposits or market-link investments. I think the challenge bank has got is to grow the pie. The pie is not just limited to what we have been seeing so far.
Right.
That is the reason Raghuram Rajan gave differentiated licenses to us. To expand the pie beyond the cities, beyond the towns, and to go to the villages. Raghuram is a classmate of mine from IIT, and I've had long discussions with him on why differentiated licenses. And now we come to understand, and I'm heading one of these differentiated licenses. The issue for us is to actually convert from the village lender into the regulated entities, whether they are deposit-taking NBFCs or cooperative banks or regular banks. We have to grow the pie to bring things into the regulated economy. The issue of mutual funds versus deposits is a long settled answer. Banks must encourage mutual funds because it's the same customer. If you want to hold on to your deposit and not let it go into a mutual fund, that customer will find some other bank and go to mutual funds through that.
Right, very valid. Yeah.
So essentially, you have to support the customer in the customer's journey. But what I'm trying to say here is that For too long, banks have thought of customer as one customer. It is not. It's a very differentiated cohort. It's a very scientifically sliced and diced set of people. One of the big reasons my bank we're the youngest bank in India, and we are already midway through our journey amongst the SFBs, getting to the top pretty fast. Why? Because we have got women accounts which we call pearl accounts for women who need a special attention to the way they do banking. For traders, we've got traders accounts. Senior citizens, everyone has an account, so do we. Essentially, you have to segment your segments, understand your micro markets, and then address and pitch to what they need.
Right.
It's not always just deposits.
Right.
With deposits, you have to go in with a little bit of overdraft facility for traders. We have to go in with credit cards for different people, especially young people who can't get a credit card without a credit history. So you have a parent, you have a minor becoming a major, offer a credit card. We have a credit card which we call educational limit. We set up credit cards with 5,000 rupee limits to educate the person how to use credit in the country and increase their credit score. So, we banks, we have to learn that it is not one size fits all. It's a very different set of people, and we have to now become humble enough to understand them and cater to their needs to take the country forward.
Right.
Mr. Manian, do you concur with what Mr. Camotra said that?
So the way I look at it is a macro. If you look at the macro, India is still a country where the pyramid is huge, right, at the bottom. And I think there is still an upward migration happening, significant upward migration that is happening of customers. And clearly, I don't think the investments as a percentage of GDP is dramatically lower than. So the question for banks is a smaller share of a large pie is still larger than a large share of a small pie today, right? So the way I see it is India has a long runway where it can still grow. Even now, single digit percentage of people invest in equities. Just about double digit people invest in mutual funds. So I think our pyramid is still very small at the top and the bottom is very large.
Right.
I think this migration will, for a long time from now, continue to happen, and therefore banks, they will get a smaller share of the overall financial assets. They will get a smaller share, but that smaller share will be bigger than what they have today. That is one way to look at it on a macro basis. Second is, of course, my colleagues have already said on the panel, I think banks have to look at a customer as a holistic, and you have to serve the customer holistically, make fee revenue, and in fact, if you see internationally, many banks do not hold their assets necessarily on the balance sheet. You have to assume, you cannot assume that we must have a model where all our assets sit on our balance sheet and all our balance sheet must be funded by liabilities, deposits. I think the models will change. Banks will hold some of the large assets today they hold. If the investment markets grow, debt markets grow, they'll be able to offload those assets. So they will also need lesser. They'll have lesser need to fund those assets on their balance sheet. So I think the business models will evolve. So for example, what I call the originate to distribute and not originate to store models will happen. So there are many things. I think we have a long runway of many other options to happen. I don't think we are staring at the end of the tunnel just now. In a country like India, which is like poised for growth, I don't think we should think on those lines. I think
What's your sense? What's
your
your sense? Yeah.
only on 2 points. Right? This is just to me, from a country perspective, I feel that savings, investments, etc. have been done traditionally also with multi-asset classes. It has been with gold, it has been with land, then it moved to maybe right in terms of a banking deposit, etc. So to me, if from banking deposit it moves to say mutual funds, and say from mutual funds tomorrow to a crypto or another asset class, etc., it is like part of cycle of growth, cycle of right in terms of how truly the asset classes that are there for the citizens to consume and distribute their money into it, right? That's the way it will be. So don't look at just one asset class or one product kind of a scenario, because it is definitely bound to change, because we are in that kind of growth segment. That's a limited.
Let me add a few more things.
Yeah, sure.
You know, customers, at least my experience is, customers who are active in capital markets, their balances with us are much more.
Yes.
The CASA balance is actually much higher. So I don't think, so I love a customer who's in the capital market because my CASA is more.
He's an investor or a trader? Because
No, even investors, their dividend flows happen, their redemptions happen. More the transaction, more the CASA. CASA is not competing with investments, right? So I love those customers. So it's a positive one. Two, when you say investments are moving from deposits into mutual funds, where do mutual funds bank?
The banks.
Thanks.
So it's the nature of deposits and the complexion of deposits that changes. So I think these will change with times. There will be cycles. There will be cycles when markets are not good. So I think on a long-term basis, I don't think the debate is whether banks can get deposits or not. I think they will get, like I said, they'll get a smaller share of the overall financial assets. But I think we have a long runway.
See, you need to understand one thing very clear. Nobody is fighting with the fixed pool size.
Correct.
If suppose we say that there is one drain of a deposit moving into another one out of the fixed pool size, then there is a concern. The pool size is it's not a dimensional decider. It just grows in all direction. And it keeps growing from the bottom, as has been said very clearly. When the pool size grows, the aspiration of the people to move from one class of asset to another class is a natural. When the natural progression takes place, you should be providing them an opportunity to do those transactions as part of the service provided. That's why I said now you no longer a simple deposit in advance. The mutual fund at the maximum, what he will do in case of need, he wanted to build a house, he can't take at the maximum less loan against the mutual fund, he will take it, but he has to come to the bank only for housing loan. So the system coexists and complements each other for the growth of the country in a much faster rate. So he comes back to the housing loan. When he comes back to the housing loan, naturally he has to provide the EMI. So his salary account will be the bank. When salary increases, naturally the accretion will come here. So the people started differentiating between livelihood spend and lifestyle spend. Lifestyle spend, wherever the surplus is there, it may move towards some higher investment, higher travel, discretionary power, other things. So previously, a decade before, your opportunity to swipe the card across the globe was much limited.
Yeah.
It was the top. Now today, you look at it, almost everybody in the Zoom will be having some 3 or 4 credit cards with them. So your credit worthiness of the people have gone up. When you swipe it, you have to bring the money back. When the velocity of the money decides the deposit growth, and velocity of the money decides about the economic growth. If I keep holding the money and putting in the savings fund and getting around 4%, 5%, 6%, whatever the rate of interest forever, neither my wealth is going to grow, nor the velocity is going to bring in, velocity beheads the money. 1 rupee becomes 10 rupee, 10 rupee becomes 100 rupees. Yeah. So this natural progression, what we see is a good for the ecosystem rather than for the two different asset class service providers.
Yeah. So Marathe, on this part of credit worthiness, quite the RBI has raised the concern over unbridled unsecured credit growth. Yet it seems that the push for today the banks, given that the private capex cycle is not taking off, remains the retail portfolio to push through. So what's your understanding of where the growth for the industry will come?
See, the stress that we noticed in retail finance was particularly in 3 areas: totally unsecured loans, credit card outstandings, and microfinance. And in microfinance, what we realized was, irrespective of the repayment capacity or the earnings that the borrower had, there were multiple agencies which gave him loans one after another. Typically, at one point of time, a borrower was having loan accounts with 4 or 5 institutions. And he used to take a loan from a new entity to repay some other loan. And that is how the indebtedness and the problem started. So it's not a very serious issue except for a few banks today and some of the NBFCs. Things are under control and nothing has gone haywire as we see. Timely and setting the alarm bells has enabled the banks to take corrective steps. Even NBFCs have taken corrective steps. And as a consequence, there's no crisis in it as of today. Microfinance institutions and some of the small finance banks which had extended a lot of microfinance, they are in some stress, but I believe next year they all should be out of the trouble. So that shouldn't happen.
Mr. Camotra, just on that note of, MFI, small is beautiful, but now small is stressful, right? For you as a small finance bank, while MFI gave you that kind of, ROA kickers, but the fact remains that you're not having enough of good credit-worthy borrowers out there. So how are you managing that trade-off, growth?
Actually, at the outset, I want to clarify that retail bank is much more than MFI. In retail lending, we do a lot of secured lending. Most of the SFBs have a high percentage of secured lending. I can vouch. We do secured lending in LAP, affordable housing, supply chain finance, gold loans, LAS. There's a whole slew of products which are secured and completely safe. What Marathe sir is saying is correct. MFIs has been stressful to some of the small finance banks in the past. The genesis is of the 12 small finance banks, 8 had come from microfinance origins. Unity, of course, came from a very diversified base, as did AU Finance and Capital Bank. But 8 of them came from MFI and still held a fair percentage of their portfolio. But of late, MFI has also become different classes. The typical JLG, which is a joint liability group, is the one which came under most stress. People have graduated to Saral, which are individual loans to women who have successfully repaid their JLG loans. They've graduated to MEL, which are medium enterprise loans for ladies who actually do some enterprise at home. So, just like life finds how to survive, all retail banks have found how to survive, and they have started taking variants which are better credit worthiness and still give good returns. I'm visually seeing, I'm on one of the boards of the SROs for microfinance. We have limited that no SFB will give more than 3 loans. Maximum loan size will be 1.75 lakhs cumulatively. So that has brought guardrails into the industry. Industry is recovering very well. And I have a sense that the next time we meet in a panel, MFI will be again a thriving industry, as it has been in the past. So retail bank actually is the driver for growth, because India is MSMEs, medium, small, traders, and that's where the growth will come for the country to go to higher levels. So let's watch the space. Retail bank has a long way to go.
Mr. Manian, Mr. Camotra said, banks are learning to survive, but survival is not a strategy. It's not a growth strategy. So how are you kind of pacing it? Because the competitive intensity, everyone seems to be talking of gold loans as the next big thing. You already have NBFCs out there. So how are you looking at the opportunity to grow your book?
Particularly to my bank? No, so, we are a bank with, India is a large country, and, banking market shares are we are at about 1.4% market share. So, many banks will be 1.4, and the biggest, of course, keep SBI aside, otherwise people are just hitting the two-digit mark, right? So it's a distributed market. It's not, India can hold 10 banks comfortably, right? India is not a country where there will be 2 banks or 3 banks. So I think there are 2 ways I look at it as relevance. First, on a general basis, you have to be relevant to your customers, right? So relevance sometimes comes out of share, size, things like that, or it comes out of specialization, like you mentioned, some people specialize in gold, it can give you scale in gold itself. So there are, you have to choose your strategy on what you do in terms of whether you are aiming for size as a relevant. Of course, there is at some point in time, size matters, right? So you need, but that doesn't mean you have to be the largest. What you have to be is relevant size. Right? So I think as long as you can get a relevant size, being a generic and across multiple products, you can still be. It can be a strategy, or choose segments or products and specialize in those and be able to do significantly better than your competition on that, deliver value proposition to customers either in a segment or in a product. Those are the three ways to be relevant, right? I would say each bank has to choose what is their strategy out of this. Sometimes it could be mix of the three, in depending on what you are going, where you are placed. So I would say we are more on the first. Each bank will choose their own strategy. Some may be on second, some may be on third.
Mr. Kumar, what's your thing? Where are you gunning for?
If I come specific to the bank which I'm heading right now is in RBL, you look at it, it is a very 3 years before and 3 years now and 5 years before and right now and 5 years ahead. The model emerges from the peculiarity of this bank. If you look at it, my liability franchise, 60% are from segment. What I mean by segment is an affluent group. So naturally, the most natural alignment there would be to provide them a bouquet of services and facilitate them to look within rather than outside the bank for any products and services. That's the first simple strategy. That strategy may drive interest income. That strategy may drive fee income. That's a combination one has to work with. That segment, what it is looking at is that it's ease of doing business. It's not a fast delivery. They are looking at ease of doing business. How quickly they are able to reach out to the relationship manager, how quickly. This is exactly what the differentiator as far as we are strategically. And we also have a large acquiring book in form of a credit card. We are rather, for our size, we are one of the very pioneers in credit card. 5 million customers are there. You may ask, when you have so many of credit cards, is it not a risky? If you take it as a standalone, SBI card must be the most riskiest product in the country. But what to differentiate between SBI cards and that of ours is that we work with that deposit of our depositors. They borrow from some other bank. The funding model difference. So consciousness which comes from that, to what extent we can underwrite the risk. So the risk underwriting for us in that segment will be a little higher than that of the other cards we are doing that's another differentiator strategy. Very important thing where the country is growing. We have been speaking for last 15-20 minutes. We kept on saying that the bottom of the pyramid keep moving. So you are one of the big players in MFI. See, MFI, a lot of said thing. The MFI problem, what we saw last time, it was not on the demand side problem. It was a supply side. So the supply side problem turned out to be an issue for the people. When I give a supply, if that person who is borrowing is going to use it for livelihood purpose or lifestyle purpose. Unfortunately, during this last 1 year, most of this borrowing has gone towards lifestyle. In the sense what? Take the money, buy a TV. Take the money, buy a fridge. Had they taken it for livelihood, that is what, because baptism for most of the people in our country takes place through microfinance only, because that's the first formal entry to, I'm talking about the country as a whole in terms of percentage, not from the urban, even in urban also microfinance used to be there. But the baptism takes place. If that particular induction is for livelihood, we would not have faced. So partly it is a supplier who just told them, "Arey kuch bhi karo yaar, mujhe kuch problem nahi hai." Right? That is where the regulator just stepped in and say that you can't be. You baptize any number of people, whatever the rate you are going to do, it should be a moderate rate. It cannot be like the local money lender. But see that it is for the livelihood, not for lifestyle. When that correction takes place, the unit is going to be far more groomed and growth will be there. So we have that unique proposition of having around 8% of my balance sheet in that particular book. And we see that book as a one pristine book. Thanks to that SRO, self-regulation comes into picture when you start burning your back and front of your palm, right? Yeah. So the self-regulation stepped in. Now with this kind of self-regulation, this bottom of the pyramid in my strategy is going to work out the way we have been planning for. Most important strategy in any bank, in my view, and especially it related to my bank, is that you need to have all the products. Some are sales products, some are balance sheet products. Like every shelf product need not be a growth oriented product. The purpose being that if my customer or the client with whom we have a relationship is looking for a product, he has to look back at the shelf. Do you have that display? Okay, then I'll pick it up. That's why why we were cornerstone kirana stores gave way to that malls, gave way to that bigger self-servicing stores, because you go there and pick up what you want. So we have a very simple strategy of providing all the bouquet of products on the shelf and meet the customers through a very strong analytics. I have a very strongest analytical team with around 200 plus people who get into the hyper personalized is what today's world. Today, possibly if you have an ability to analyze and see that what is going to be his next purchase cycle, if I am able to fund it, possibly I am there in the game. So that is exactly the direction in which we are moving. And this is where almost most of the banks must be in different stages of that life. We are slightly in a matured stage as far as this particular.
Is it AI based?
Yeah, it is a partly AI based and ML based. It's ML is one which is working very deep. See, here I feel that still we have not gone to that stage. I have my own AI bias cannot be removed. So keeping that AI bias into the view, we have gone into little deeply into the ML. So our machine learning based on, we have a huge data for the last, so I was 82-year bank and 2012-14 onwards, we are having a huge customer base and mass. Their behavior, the transaction behavior is able to throw a lot of lights into it. So the machine learning is just throwing a lot of insights into it. AI, yes, of course, it has come for one of the, I must say that when we are talking about the cost, I always adore AI for using it in the mundane work. The routine, repeated work. If somebody pick up on the call and ask, we don't love to have our skilled resources to answer them. What is the balance? What is the transaction? We would like to replace the humanoid. Just put that AI. IVR we are replacing with AI. IVR is irritant. I'm sure that you say, ek dabaiye, hindil ke, do dabaiye. You get irritated. So you just cut the phone. I put an AI there. AI is going to talk to you. Hi Vaishnav, how are you? What's that you want? Sir, I want to talk to somebody about credit card. What do you want in credit card? That's the end of it. You get the balance and get the things. That's where the AI comes. What I feel is it provided a smooth experience to the caller as well as the better cost-effective provision for the banker. This is exactly where the AI bridges. And these are the areas. And of course, we have gone in AI in for fraud transaction delete. If you do a transaction, and now we have an ability to identify and say that whether it is trending towards fraud, because exact fraud is something which requires a confirmation. Trending towards fraud is something we immediately pick up and we are able to get contacted. Around 13% of the cost, the fraud we are able to prevent. As we speak today, of the total number of 13%. And another 13% we are able to pull the money back and give it to them. That's thanks to our ML, AI, and it's a hybrid combo setup. Where AI says that hands up, the supervisor steps up and do it, because AI cannot do everything what is being asked about. Maybe the days are not far off where it may mature much better than what it is today.
Now that you're speaking about AI, is now AI now the holy grail? I mean, the point that, Parthasarathy made that, ROIs on tech has not yet delivered. And now here we are talking of enamored by AI. So, Mr. Manian, how as a banker you are making that trade-off? Are you really seeing value in what AI is bringing to the table today for a banker? Or is it again a piecemeal?
Perspective first before he answers.
Yes.
That would be better, I think, right? So when I said the tech investments that have been made in the last 2 decades and the ROI, right? Really, if you have to calculate the ROI, definitely every banker will know that it is not to their 100% satisfaction, right? And it has to be refined. AI, if you classify it into the 3 categories that you really need to categorize, right? First, I'll go with data, right? Data in its raw form and data in its refined form, and the data and the insights that have been built over a period of time because of the time that has been spent on looking at the data the way in which it needs to. I think that has gotten to a level of maturity which is significant, right? You can get insights to the point even that Sir made on the prediction of fraud detection, right? Or what can happen. To that level, it can definitely give you the data point. Fraud detections can be predicted You can have predictive analytics on what may go wrong, etc. So data has got to a level of maturity which is significant. Then comes on top of it whether you really want to use artificial intelligence or generative AI, or you want to use agentic AI, and what is the kind of maturity that you want to go to, right? Of course, some of the areas on Gen AI is not 100% proved. People are still, some of it is already there in the industry today, but still the bias or the level of transparency that you want to keep, and everything that needs to be hallucination that you want to avoid, the associated risk that you want to go away from, etc., will come. For it to come into the mainstream 100%, it is in the way. I would say it is not yet fully there, but it is there on its way. It is not too far away from it, right? But agentic, if you look at it, for it to really do things like in handling call centers the right way, or right in terms of doing the mundane tasks of operations flow, right? If I have to take retail operations in a simple way of a bank, and how much can I really give it to, right, in terms of AI or agentic AI? The answer is a big yes, because you can immediately give it to them, because or call center transformation, as part of that I want to put some agents there as part of answering and as part of picking up the data. The answer is there as a pretty clear yes. That's also true for technology, right? In terms of from a technology life cycle management, right from my business requirements up to testing wherever I can go, can I use, right, in terms of AI or agentic AI to the level where I can get the efficiency that I need to get in? The answer is yes, right? So that is coming in without a doubt, and organizations are using it, right? Today, the kind of results that you will get by giving them those tools, your own team's productivity is unbelievably high, right? That's where it is in terms of from a improvement.
Just one point before Manian takes over. You keep talking about ROI on technology. Is it a pure balance sheet P&L number or otherwise? I just give a simple example. Can any one of us run the bank? The moment I plug a simple wire from my core switch, can I run the bank? That is the ROI of core banking solution. I can't run the bank. The bank will collapse, because that is an extent to which it has come for replaceability. So you have to look at the ROI from cost of replaceability. If I look at it, it's a phenomenal ROI technology is provided to the banking sector, not on the P&L side.
Coming to the question you asked, I think AI, it is still early days. Obviously, there are not applications at scale that have been deployed, but I think there are several small experiments in areas that has happened. And I would say different banks are at different stages in applying it to some areas. But to me, the most promising areas, at least what they look like promising to me, and one is in the areas of risk and simple tasks. Like for example, simple tasks like writing credit notes, operations. There are lots of simple tasks which I feel without much hallucination errors, without much with a human in loop, but you can do significant amount of productivity linked work. So this whole area of productivity and enhancement kind of use cases seem quite interesting to me. The second area which looks interesting to me is what she mentioned, things like simple AI stuff where recognizing language, call centers, assisting our own employees in internal tasks. For example, now I write all my mails and I run through Copilot. I write the points. I don't write the mails. I write the points and it gives me the mail. Of course, I edit and then I send. So there are lots of such things, and it saves me significant amount of time if all my workforce does that. So there are several productivity improvement tools. There are some agentic kind of tools, which are the two that look promising to me. Yes, of course, there can be many more things that you can talk about, but these two look promising to me.
While we would love the conversation to go on, I think for the time reasons, we'll kind of wrap it up with one outlook question. And I would like Mr. Marathe, as let me not put you as a central banker, as a banker, tell me what's your growth outlook for FY26? Like just pause.
No, we would continue to grow fast, and whatever the projections have been made for GDP, that certainly we'll achieve. We should be doing it better. That's what I feel. See, for banking sector, I always look to three points: scale, speed, and providing secure services. If you are able to address the three S, it will give a big push to the economy and should be growing much faster.
Thank you.
Thank
Yes, Parthasarathy.
Definitely, I think we will achieve the growth, right? I think maybe, as Sir said, we should overachieve the goals, right? And the economy should definitely go up, right? And banking sector is definitely, as I said, one of the most important for that growth. They will do it.
Mr. Manian.
I would say the sector is in good shape, health-wise. Generally in good shape. Looks like the economy will be at the 6 point. You can argue 6.3, 6.5, but definitely around that range. And if that happens, I think the sector is capable of keeping pace and running with the growth that happens. And I am quite optimistic about and especially given that the rate uncertainties are behind us, and the way I look at it is, we took a quicker rate cut that brought forward the bottom of the cycle faster, and therefore from the third quarter of this year, can we hope to do much better than or maybe regain back our kind of NIMs that we made 3 quarters back? Possible, looks possible. So I'm reasonably positive about the prospects of the industry.
Mr. Camotra.
Basically, three factors. Last year, the banks in India gave the highest ever dividend into the central corpus, which is a great base to start. Second, the Reserve Bank has been very benevolent. It has given us the tailwinds to sail into a great year, 25-26. And third, the geopolitical pressures around the world. I think India will navigate well and take advantage of these so that our financial industry actually provides the impetus for the growth of the entire country. I think it will be a boom of a year, surprising all pundits by busting the numbers we have done so far.
Very quite interesting time of the history we are. We have already seen the bankers doing a technology and technology selling a banking product. The convergence has taken place like Ganga Yamuna. Now the mystical river Saraswati is going to join in the form of AI, going to make it as much more interesting to us we move forward. That's what the banking technology today.
Yeah. On that note, thank you, ladies and gentlemen, for taking time out and making this conversation a meaningful one. Thank you.